So what's happening, guys? I know that we usually talk e-commerce here on the channel, but today I want to talk about investing a little bit. I want to talk about where I think money is going to be moving, and also potentially where a big opportunity is for a lot of us. Now, this is not investment advice. I'm just some dude on YouTube, but I'm just sharing with you my research, what I'm seeing, and perhaps you can learn something from this. And we're going to start actually with the generations, as you can see here. So if you're between 57 and 75, then you're a baby boomer. 41 to 56 Gen X, 25 to 40 millennials, and 9 to 24 Gen Z. And then this shows the wealth within each. So of course, baby boomers is the highest, 65 trillion. You got Gen X 22, millennials 6 trillion, because they're obviously starting at the beginning of those stages, whereas the older generations, of course, have acquired more wealth. And then Gen Z, of course, still has to really begin. And so what I want to look at here is, where was the big opportunity for each? How did real estate perform for each? Is that an opportunity today? What about the stock market? What about bonds? What about precious metal? And of course, what about crypto? And how does that all mix together? So let's start with real estate. And so here you can actually see the generations: boomers, Gen X, millennials, and then the average house price. So what I've done is just chosen a point within each generation, then like 20 years on. So they're probably looking at buying their first house and investing a lot of their money in real estate, or investing money in that over time. So you can see here the average house price for the boomers, if they bought in 1970, was £4,057. Now this is the UK, but the trend is really similar even in the US if you look at the graphs. So it was 4,057. The average for Gen X was 56,800 in 1991. And the average today is now £268,000. And this is actually low. I was reading an article 2 days ago which said the average house price sold currently, shorter term, is about £330,000. So a lot higher. Now I know that it's not a very good reference point because money was worth more back then. And so what I've done is I've looked at, okay, well, how much did someone earn in a year compared to the average house price? So looking at the first one, boomers, this was actually 3.89 times the average annual salary. So what you earn in a year, buying a house was 3.89 times that. So you had to spend 3.89 times your salary. And for Gen X, that was actually 4.15. Okay, so you've got to spend 4.2 times your annual salary to purchase a house cash. But this is a good ratio. And then if we look at today, and keeping in mind this is a bit of a lower number here, this is now actually 9.05 times. So you have to spend 9 times your annual salary on average, the average annual salary. And so this is a very good reference. Property has gone up massively. And if we actually look at this another way, where we look at the returns gained, you will see that the likely return you're going to gain currently investing in property is lower than investing back here. And this is one of the big reasons for that big accumulation of wealth, up to, what was it, 65 trillion. So if you look at, so what was the ROI on this investment to today? That was 6,500%. And the same for this one, up to today, for Gen X, was 380% almost in terms of ROI. So a huge growth. And yes, if you purchase property today, it's likely to go up over the long term, but you're not going to see this kind of growth in that same time frame, in my opinion, unless you have massive debasing of the currency, which is actually a possibility. And so you can see that this is probably not as big an opportunity for millennials currently. In fact, with house prices over 300,000 on average, you have a lot of millennials struggling to even get the deposit together to buy their first home. And so moving on to the second most popular, probably being stocks and bonds. Let's look at the bond yield. So I know that bonds are not the most exciting thing, especially now, but let's look at the 10-year treasury and the kind of opportunity when investing in that at different times. So you can see here for the boomers, it was about 7.9 up to 7.9% yield if you invested in bonds. That was in 1970. By the way, it went all the way up. You had a 15% yield in 1981. So from there, it just went up to 15. For Gen X, was up to 8.2% in 1991. And for millennials, it went up all the way to 1.6% in 2021. So bonds, really, you're going to get very little yield, very little return on that. And I don't think we're going to see many millennials and even Gen X putting cash into bonds just because earning 1% is not exciting. And so let's move on to equities, investing in the stock market, the S&P 500. And here, I don't think it's fair to really compare the different years and generations, because overall, the S&P 500 has performed very well historically with very good annualized returns, and even recently seeing very, very good returns over the past 3 years, even this year performing well. But there's also something hidden within that people are starting to ask, is that just going to continue? Are things overcooked? And so at this point, what I want to do with the S&P 500 or equities in general is just look at a couple metrics I think you should know. The first is to do with money printing, which is M2. And when a lot of money is printed, it does cause inflation. Money printing leads inflation. There is a little bit of a delay. Now I'm going to put up a graph on screen here to show you the money printing that's been happening lately. And it's extreme. In fact, this year, they printed almost half the dollars ever printed in the world. And so if you think about it just logically, naturally, if there's more of something, it becomes less valuable. Each one of those things becomes less valuable. And if I'm going to buy a good, I should be exchanging more of those things because they're so plentiful for that good. And so goods should go up in price. They should be worth more of those things, in this case US dollars, which is kind of the global reserve currency now. So money printing's gone up drastically, but we haven't seen a huge rise in inflation. But if you look at the numbers, that is beginning to creep up. And so money printing causes inflation, and we can measure inflation through a CPI, a consumer price index. And I'm going to show you how we're already starting to see the after effects of that money printing. Things are becoming more expensive, and I'll share with you how this impacts the stock market in most cases. So here is the CPI for these dates. This is a year-over-year percentage change. So in May of 2020, we had 0.1% change. And then in March of 2021, we actually have a 2.6% year-over-year change. And now in May 2021, we have a 4.7% year-over-year change. So this shows you the trend that the consumer price index, that kind of basket of goods, is going up significantly in dollar terms. And so we're starting to see the creep of inflation because of all that money printing. So what does that matter with the stock market? Well, stock market valuations are inversely related to inflation volatility. So that means if inflation is volatile, it starts drastically increasing, then stock market valuations are inversely related to that. They react to inflation volatility. Now with the stock market at all-time highs, which way do you think the stock market's going to react to inflation volatility? And I'm going to overlay a chart here where you can actually see that relationship, a rise or fall in the volatility of inflation causes an inverse change in the stock market. And the next factor we need to look at is unemployment. That is a massive determinant of the stock market. If we look at history, the two really interact a lot with each other. If unemployment is high, if a lot of people are unemployed, don't have jobs, the stock market goes down. If a lot of people become more and more employed and unemployment drops, then the stock market goes up. And so if you look here, in 2018, we were at about 4% unemployment. In 2020, of course, due to the current situations, we went all the way up to 11.4%. And that has been recovering very, very slowly, but it's still incredibly high at 10.1% in 2021. And some countries are even worse. Far worse, like 3 times worse. The problem is this is not recovering quick enough, and even the forecasts say that it's going to slowly come back, but the forecasts even for 2025 are still at 6%, which is still very high historically. The problem is, and the very confusing thing is, that this has not impacted the stock market, and that's why you have a lot of people saying we're overblown. And I agree with that. And I think the next point's really going to emphasize that as well. So you can see from that graph, we should be coming down with the stock market. That would be natural, and it wouldn't be the worst thing in the world. That's how a market should perform, up and down, but the trend overall is up. Instead of things being, I don't want to use the word, but I am going to, manipulated in a way that allows it to continue upwards, people keep buying the very, very top, and then you have this massive fallout and crash, which makes that dip so much worse. And then people sell at the bottom, and that's what we saw in 2008. And so let's look at the next point, and then you can make a call, you can make your own prediction of which way you think the stock market's going to go. So this is the Shiller PE ratio, which is price earnings ratio. Now, I know a lot of this jargon can sound very complex, and in my opinion, a lot of it's made to sound really complex so that you don't understand it. So price earnings ratio is really simple. A company earns money. So for each dollar they earn, what is the price of a share within their company? Now, the price for buying their stock, for owning a piece of that company, should be higher than them earning $1. So you shouldn't be paying a PE of 1 because they're going to be making more and more money in the future. There's other factors to a company other than just that. There's brand value, etc. And so you should be paying more than 1. But that price earnings ratio can also get overblown. In other words, your price for buying a piece of that company, buying a stock or stocks of that company, can get way too out of reach with their earnings and how much they're making, whether that's selling their product or service, etc. And so that's what PE ratio represents. And the lower it is, the closer in line the price of the share is to how much that company earns. And so if we look at the biggest crashes of all time in the stock market, the PE ratio, the Shiller PE ratio, is very telling. When that gets too high, there is a huge crash in the market. So you can see in 1929, this was Black Tuesday, it was 33 times. That was the PE ratio. In 2000, the dot-com bubble, it was 44 times. That was the Shiller PE. And so it's very impactful on something like the S&P 500. And then you can see 2008, 27x. So, of course, we're still just going up and everything seems fine. So what do you think the Shiller PE is today? Well, it's not as high as this one, but it's actually higher than both of these crashes. We're actually at a 34 Shiller PE. And that tells you that companies are massively overvalued on the stock market. You're paying far more than what their earnings represent. So this is another major consideration. And especially if you're an index investor, I myself am a value investor, so I'm choosing specific companies. I don't buy big indexes like the S&P 500. This, of course, is more of a problem if you are an index investor and you buy like the market index S&P 500, because there are so many companies in there which could have this problem. So this is something when you value invest, you can look at individually for the company and what's its PE. But for an index, much harder to do. And so these kind of trends are really going to impact the S&P 500, whereas some other companies might get by because of some of these factors. And I haven't chosen metrics that look bad. I've just chosen general metrics and things that do indicate where the market is going to go. In my opinion, it doesn't look very good. I think a correction is definitely due. I think if it had its kind of natural correction, it would have been better. However, it looks like the money printing and the stimulus has managed to give people excess money where they've been able to put it into stocks. You've had companies doing a lot of stock buybacks. And so this has really supported the market. Interest rates are at an all-time low. So that means people can loan money. They can loan cheap money. Paying it back has very low interest. And so they're doing that. And then that money ends up in the markets. And so that's where we are currently. But according to history, which doesn't repeat, but it does rhyme, these things are going to culminate in a correction at some point. And so we get to precious metals, so gold and silver, as you can see here. Now this is 2016 to 2021 returns, as you can see here, and then an average annualized return. So over the past 10 years, how has that asset done? So from 2010 to 2020, it's the average annualized return. And you can see for gold, we're at 3.5% and silver at minus 1.7, which is a little unfair because it did really well in 2010 and then not so well in the other years. So if you bought in 2010, it wasn't a good investment if you bought at the top. Now, personally, I see even more upside for silver than gold. That's just my opinion, because I think it also has a lot of use cases in industry as well. So I think that's the one which I would say is more undervalued, a little more suppressed. And then, of course, you have gold, which does have properties which make it really valuable. It's rare, it's been used as money. In fact, it's the only substance which over time became used as money and actually used to back our current paper money. But now we're, of course, in a fiat currency system, which we're going to talk about in a second. But overall here, looking at the money printing, the likelihood of the stock market correcting, these are times in which these assets do perform well historically. So I can see gold getting to a $3,000 level. I can see silver also getting perhaps even to a $30 level, because people are going to move back into the rare assets. They're going to move back into the things that fundamentally make sense because they're rare or valuable. That's what I think we're going to see, even if it's short term. I do think we're going to see these increase if the stock market corrects and the money printing, and that does end up causing the problems we think it will cause. But one thing I do find strange currently is the Federal Reserve actually just announced that they admit that the current path that they're on, their policies and strategies, are not sustainable. They literally admitted that, and yet we see a decrease in the price of gold. And so things are very, very strange currently, but I'm just giving you the historical view of what usually does happen. But since we are talking about millennials and where we're going to be putting our money, and even some of Gen X, I don't think millennials are going to be buying physical gold and silver. It just raises a lot of other problems, like where do I keep it? Can I move country with it? Do I need a custodian? How much does that cost? And so you might see millennials getting into ETFs with these. But again, we have seen over time, and younger generations are more clued up on this, we've seen governments confiscate gold. So let's say that there is a huge drop in the stock market and a big run to gold. Perhaps people don't even want to be a part of the fiat money system and they run to gold. The problem is that then that takes away a lot of power from the Federal Reserve to print more money. And so that's when they put restrictions on gold. That's when they even confiscate gold, or you have to turn it in for a set amount. And so we've seen these problems. We're a bit more clued up on that. And of course, whether you have physical gold or you're in an ETF, both of those will be redeemed. We've seen that even the old gold contracts were confiscated. And so in the same way, that is a risk here, and it's more known at this point. And so now let's add some of the other assets and look at the 10-year annualized average return. So we have bonds, 2.8%. That's actually US treasuries. Global treasuries were, I think, 3.5%. S&P 500, 15.1%. So actually really good. The problem is it's just completely overblown at this point. And then we're going to add Bitcoin. So remember, this is not a snapshot of like a bull run or the best year or anything. This is a 10-year annualized return. So Bitcoin is at, I'm actually going to need to make this a bit bigger, 254%, 254.2%. So you can see that is far greater than any of the others here. Doesn't mean it's better, could go up or down, but it's a 10-year annualized return. And when I saw this, it actually shocked me a bit. You guys know I am a believer in crypto. I'm a fundamentalist. I like what it represents as well, not just being a way to make money. But when you look at this, that has to stand for something, being a 10-year annualized return. But at this point, I think we can cross one off of our list. So I don't think many people are going to be putting their money into bonds. And so finally, let's look at market cap, which is basically the capitalization of each area. So how much money is in each area. And you can see here, and I wish I could draw this to scale because it would be even more powerful. These ones are actually too big, but you can see global bonds is absolutely massive. This is debt. It's 119 trillion. You've got US stocks, 49 trillion. So absolutely huge. Then you have gold at 11.3 trillion. So there's a lot of capitalization in gold. You've got Apple next at 2.2 trillion. Then you have silver at 1.4 trillion. And then these tiny dots here, this one, 1.3 trillion, represents the total cryptocurrency market cap. So it's not just Bitcoin, but it's also all of the altcoins, Ethereum, etc. And so you can see just that the entire crypto market is smaller than the capitalization of silver and almost half the capitalization of Apple, of one company. Yes, the most valuable company, but almost half of Apple. And then, of course, down here, you have the smallest circle, which would actually just be a speck. And that is Bitcoin. Not even 1 trillion market capitalization. It's at 0.6 trillion. Now remember, we started with our generations. Boomers 65 trillion, Gen X 22, Millennials 6.1 trillion. Now what I find interesting, if you put some of the company investment, the recent company investment into Bitcoin and crypto, if you put that aside for a second and you think about millennials, it's just 6.1 trillion. Okay, that's the wealth they have. And the crypto market is 1.3 trillion. Now, we all know most of the investment happening here is likely from millennials. Some Gen X, very little boomers, but mostly from millennials. So you can see that, like, let's say it were all from millennials. That's over 1/6 of their wealth. That means, I mean, you're talking about almost a quarter of what millennials have has actually gone in here. And I'm just speaking very broadly here. But you can see that's where I believe a lot of millennials are going to be putting their funds. Now we do have, some of that is definitely from company investment recently, but overall I think we have a large majority of millennials thinking about crypto. Now, over time, this wealth is being passed down here. So which of these do you think is going to get bigger? My opinion, I think that a lot of the wealth tied up in specific things here that are said to be safe, that are said to yield really good returns, I think some of those are really going to move to the innovation side. I think that wealth is going to move to these smaller circles. And just looking at this, like for me personally, I'd love to hear your opinion as well. But these have got to get bigger. I mean, just my opinion, the crypto market cap should definitely be bigger than Apple. And if Bitcoin's market cap, which is like the store of wealth, probably the most pristine store of wealth asset in the world, in my opinion, when Bitcoin gets to the size of gold, not even that size, if Bitcoin gets to 10 trillion, which in my opinion is very, very feasible, and I think will happen in the future, when it does, one Bitcoin would be worth $500,000. And then you also have to consider the intense money printing. So it probably will be worth a lot more of those dollars because there'll be so many more of those dollars. But just speaking broadly on this, you're going to see that the Federal Reserves or these central banks are going to begin bringing in digital tokens. So you're going to have like a Fed coin type thing. That's where they're going to probably move everyone. Over time, it's going to gradually creep in. And I don't think that specifically Bitcoin is perhaps a threat directly to that. Bitcoin is now a store of wealth. So it can survive, both can survive within that ecosystem where, yes, you're using like the Fed coin to buy things here and there. But in my opinion, that change, which I think they're going to pretty much have to make because of all the printing and to try and move everyone to a paperless, controlled society, which I don't personally fully believe in. Obviously, there's huge privacy concerns there, and every transaction can be traced, and everything you ever do is going to be seen. And I think, but I do think that's probably going to happen in the future. And when it does, it's going to just increase the on-ramps here. And so I think this is going to grow over time. I also think since we've seen some companies coming into this space, that's also going to bring a lot of their competitors into the space. If you look at this, I'll put it up on screen here for you. But when a fund manager, so they have, you know, a group of assets in a portfolio and they manage that fund for retail investors or even corporate clients. But if they add 1% of that portfolio to Bitcoin, okay, that means just 1% of it's in Bitcoin, you can see that the annualized return goes up significantly and volatility only goes up by 0.1%. And so I think you're also going to see a lot of fund managers starting to get into this space. And speaking as a fundamentalist, another big thing I notice is when you have fiat money, you want to spend that money. It's created mass consumerism. And I think subconsciously that's because you know it's going to be worth less in the future. That's because, you know, saving it, you get nothing on that money, saving it. It gets eaten by inflation. And when you hold Bitcoin, if I were ever to ask you, okay, you can purchase this thing from me and you can use your fiat or your Bitcoin. Every single time you're going to choose to use fiat because you see it as less valuable. Even those of you who are massive skeptics of Bitcoin or don't like it for whatever reason, if I gave you both, you would probably part with the fiat first. And I think that says a lot. So it actually changes how we interact with the economy, with the world. We value our money per se much more. So that's another thing just to think about, is it kind of changes your relationship with money and purchasing things. But enough of my personal opinion. I think overall we are going to see a lot of those funds moving into the cryptocurrency space. I do think we're still going to see a lot in the stocks area. Perhaps not short term, or people are going to be choosing really specific companies if they're a value investor, or after a very big correction. I think we will still see funds moving here. I think far less to bonds for sure. I think precious metals in a very, very small part. I don't think that's going to be a huge part. However, there are actually cryptocurrencies which track those precious metals, and that's where we may see millennials and that money shift actually moving to precious metals, is through coins that actually track those precious metals. But if you did enjoy this very different session, please drop it a quick like for me. Remember to subscribe to the channel if you are new here. But let me know below, where would you guys consider putting your money? Where do you think that shift is going to go? I'd love to hear from you below, but I hope you guys are all keeping really well, and I'll catch you in the next session.